So you've got a bit of money saved and want to start investing, but you don't know where to start. You could invest in stocks, bonds, mutual funds, real estate, foreign exchange, REITs, options, futures, the latest Ghostbusters memorabilia, or even fancy watches. There are so many options out there, it can be overwhelming. And I'm sure you've seen the latest YouTube ads about day trading and the latest fad for getting you rich fast. But with all this confusion, there is a real fear out there that you could actually lose the money you've worked so hard to save up. And since you and I know that money doesn't grow on trees, I'd love to share a little bit about what I learned along the way, the good, the bad, and the ugly, and how to actually help you grow your money. At one point, I became one of those day trading stats when I lost thousands in one of my investments. I invested in a large, well-established pharmaceutical company that was sure to be a long-term success. Well, when that company went under investigation for fraud, their stock tanked overnight and I lost big. I became part of a class action lawsuit that returned to me exactly $0. And it was a hard lesson to learn, but a valuable one at that. That event in my investing journey was one step to realizing that there is real risk involved in investing in the market and to figure out a way that was better for my sleep patterns at night. I took a deep breath and realized this could be a whole lot easier and a whole lot less risky if I just took Warren Buffett's advice and applied it to my own investment life. And since he's worth over $216 billion, I think he's worth listening to. Let's dive into this simple strategy to help you get started. You might even earn more money than 95% of the day traders who lose money. This is part one of our Investing for Beginners series, and we're going to start to understand the purpose of investing and building a foundation from there. The purpose of investing is so that your money can make money for you. And eventually, the ultimate goal is that your money makes more money than you ever can. And this is the true advantage to investing. And you must invest in some way or another, otherwise the value of your money will decrease without you even realizing it. Simply by doing nothing or storing your money in a cash box or under the mattress, the value of your money decreases each year at the rate of inflation. What that means is that if you bought a new phone this year for $1,000, on a good year with an inflation rate of just 3%, that same phone will cost you $1,030 next year, and the year after that, $1,061, and the year after that, $1,093. So what that means is that if your money is not growing with at least the rate of inflation, your ability to buy a new phone or even just bread and milk is decreasing. The idea behind investing is that you would ideally invest in something that will at least keep up with, but preferably outpace inflation. This means that your money will grow over time at or above the inflation rate. So if the inflation rate is 3%, you need at least a 3% return on your investments, preferably higher. Let's say you decided to invest in a house and decide to rent it out. There are a couple of ways that this house will make you money. One is the rental income, and two, the value of the house will rise over time. If you bought that house for $300,000 at an average annual increase of just 3%, in 15 years that house would be worth $467,000. And that's just for owning the house. Don't forget you're still making rental income on the house as well. If your money was simply sitting in a checking account or in a cash box, that same money that you initially used to buy the house would not have kept up with the increased value of the house. It would not have kept up with inflation. Real estate is just one type of investment. The greatest hang up with real estate is probably that it can take a large amount of money to get started in that type of investment. And the other part of it is that not everybody wants the extra work of managing properties or being a landlord. There are many other types of investments too, all of which share the same goal that you will one day sell them for a higher price than what you paid for them. You may or may not have heard some things like stocks or shares, equities, bonds, GICs, CDs, hedge funds, mutual funds, options, futures, etc., etc., etc. The list of possibilities is endless and can be quite overwhelming. And a lot of investments are actually quite risky as well. And because this video is for beginners or maybe even somebody with a little bit of experience, let's actually make this attainable for the average person and in a way that doesn't require a massive influx of money to get you started. Remember I told you that I became a statistic when I lost my hard-earned dollars doing day trading? Well, there are people who are a whole lot smarter than I am and spend their careers doing trading, and they lose money too. They try so hard to beat the market and outsmart their colleagues, but 95% of them end up broke. Take Jesse Livermore, for example. He was one of the greatest stock market traders in the world back in his day, and by age 30, he was worth over $100 million in today's money. His legacy was sealed in history as he made the equivalent of more than $3 billion in one day. Jesse became one of the richest men in the world, but only 4 years later, in 1933, he lost everything as his overconfident self had accumulated mounds of debt and made some investments that couldn't lose. Don't get me wrong, I'm not against buying stocks. In fact, quite the contrary. I definitely believe that buying stocks is an amazing way to grow your money, but not just single stocks. I believe the best way to help increase the likelihood of steady, consistent returns is to buy many stocks, particularly within a fund. So first off, what is a stock? Stocks are investments that represent ownership in a company. So for example, if you own Netflix stocks, it means that you own shares in Netflix, which represents a percentage of the company you own. Owning and investing in some of the most successful companies in the world is a primary way ordinary people build wealth. It's not like you and I can go out and afford to buy Netflix itself, but we see the potential for growth and want a piece of the pie. So this is a way that we can participate in the company's profits or losses. The term stocks and shares, for the most part, can be used interchangeably, though there is a slight difference. Stocks generally refer to a broader range and can represent owning parts of one or more companies, and shares generally refer to owning a specific company. Or more specifically, if you say you own Netflix stocks, it begs the question, how much do you own? So you would say that you own 100 shares. Shares is the unit of measurement of how much stock you own. The stock tells you what you are investing in, Netflix, but the shares tell you how much of it you own, 100 shares. But since most people don't know the difference, the term is frequently used interchangeably. And since we're going to be discussing things on a broader spectrum, we'll use them interchangeably as well. Please give me a thumbs up so I can keep bringing you content like this. And if you are feeling extra generous, hit that subscribe button so you don't miss out on some of the tips and tricks for helping you to grow your money. Anyway, the idea behind owning shares in Netflix is that we believe the value of those shares will increase over time. So let's say you buy it today for $354 and hope to sell it in 10 years for more. And if the rate of inflation continues to be 3% over the next 10 years, we want those shares to be worth at the very least $476 to keep up with the rate of inflation. And again, remember, inflation decreases the value of your money, making milk and bread and iPhones more expensive. So you need to make sure that your investments are at least keeping up with inflation, but preferably make more, much more. Another way that you can earn money by owning shares is when a company issues something called a dividend. Remember how we talked about investment properties and that the benefit is twofold, because not only does the value of a house increase over time, but you also receive rent payments. Well, a dividend is similar to receiving rent payments in the sense that a company is paying you back to use your money. They are saying, thank you for trusting us to use your money to grow our company. You see, Netflix doesn't offer up percentages of its company or shares because it feels good and they want to share their wealth. They need capital or your money in order to continue to grow and expand their business, or to buy and swallow up other businesses, or do research and development, etc., etc. The point is they need our money so that they can make more money. And of course, if we own shares in Netflix, we want them to make more money. So as a shareholder or an owner of those shares, you receive a dividend when the company makes a profit and decides to share a portion of that profit with you. As an example, let's say the company makes $100 million in profit this quarter and wants to share 4% of that and give it to the shareholders, you and me. This way they can keep us happy as investors as we get a bit of the financial benefits along the way, as well as the reassurance that the company is still growing and making money. And as a result, you and I decide that they can continue to use our money and continue to build their business, or we might even decide to buy more shares. And of course, the reason they only give shareholders a small percentage of the profits is because they want to use the rest to continue to reinvest in the company and continue to grow, which as shareholders, we want them to do. Because remember, we don't just want dividends, we want the price of the shares to increase over time. This is important to the shareholder or investor because not only are the dividends part of your return on investment or ROI, it's also because they can automatically be reinvested and allow your money to grow faster. For example, let's say you invested $1,000 in a company and they paid you $4 in Q1. For those of you who may be wondering, Q1 or quarter one represents the 12-month year divided into quarters or 4, so that every 3 months is a new quarter. For example, January, February, March would be one quarter. April, May, June would be another quarter, etc., etc. And so if they paid you $4 in Q1 for your $1,000 investment, you would now have $1,004 going into Q2 if you automatically reinvested those dividends, which let's say earns you $4.25 in the next quarter, and $4.50 in the next quarter, and $4.75 in quarter 4. And at the end of the first year, even without the growth on the actual stock, you could have $1,017.50. So the return you've made just in dividends is $17.50, and the potential for growth continues from there. Obviously, that's just an example, and real numbers and percentages will vary, but you can see how automatically reinvesting your dividends is an intelligent way to grow your money faster. Most dividends are paid on a quarterly basis to their shareholders, though some are annual and a few are monthly, very few though. So now we have an understanding that a share is owning a percentage of a company, and we want the share price to increase over time as the company becomes more profitable, and understand that we can also make money along the way in the form of dividends when the company shares part of its profit. So that of course begs the question, what stock should I actually buy? And to that I would say that I share the opinion of billionaire Warren Buffett, who says the average person should invest in index funds. He's saying to buy all of them. Okay, well maybe not all of them, but a lot of them. In fact, a huge mix. And there's 2 parts to his advice. He says index and he says fund, an index fund. So a fund, whether we're talking index fund, mutual fund, exchange traded fund, hedge fund, or whatever it is, it's basically like buying a big bag of trail mix. You're purchasing one bag at the checkout, but within that bag there are a ton of different nuts and coconut flakes and craisins and yogurt covered raisins and chocolate dipped something or other. It's a big mix of snacks within one bag, and that means you don't need to buy a bag of each item, which could easily cost you $100. You can just buy one bag of trail mix that lets you get the benefit of enjoying a little bit of each for only $5.99. And that's the idea behind a fund. You only have to pay a small price to buy a mixed bag of companies instead of buying whole shares in each of the companies held within the funds. You are pooling your money with other investors so you each can share a piece of the companies held within the funds. This decreases your risk by increasing the variety of companies that you own. It has also made this variety of stocks more affordable since you don't have to buy whole shares of each company. You get to buy a bag of trail mix for only $5.99. Now this isn't just a random bag of snacks. The manufacturer has specific quantities of each item in the bag. And this is the same with a fund. You get to decide what type of fund you want to buy: a bond fund, hedge fund, exchange traded fund, mutual fund, money market fund, etc. But you also get to decide what objective you want to focus on. Do you want a fund that focuses on technology? Do you want a fund that focuses on healthcare, precious metals, or petroleum fuels? Based on the type of fund and objective of the fund, a manager decides what assets the companies hold within the fund, as well as how many shares or quantities of each company to hold. Let's look at the index fund that Warren Buffett suggested for an example. An index fund is designed to mimic the performance of a specific index, and an index is designed to represent a stock market. Or, in other words, a stock market is a marketplace of stocks and the buyers and sellers of those stocks. For example, you may have heard of the S&P 500. The Standard & Poor's 500 is made up of America's largest 500 companies that are traded in the stock market in America. An S&P 500 index fund is designed to track the overall performance of the market and is considered one of the best gauges of the American stock market as a whole. Another index you may have heard of is the NASDAQ. Two versions of this are the NASDAQ Composite, which is made up of almost all the companies traded on the NASDAQ Stock Exchange in New York, more than 2,500 companies, and the NASDAQ 100, which tracks only 100 of the largest non-financial companies traded on this exchange and largely focuses on tech. Another one that you've probably heard about on the news is the Dow Jones Industrial Average, DJA, Dow Jones, or Dow. It's actually all the same thing. It's made up of 30 large companies in the US, and it is a much narrower index because it only has the 30 companies. As the S&P 500 is made up of 500 of the largest companies in the US and is not just limited to one exchange, it is a much broader overview of the market as a whole and the most commonly used index to measure performance against. In other words, it's considered a benchmark. So they measure performance of investments against this benchmark, the S&P 500. That means that investors and brokers alike compare the performance of other investments against the performance of this one index, the S&P 500. So now that we know a little about funds and index options, why would Warren Buffett, who has done astronomically well at buying individual stocks, say that the average person should buy index funds? Well, for starters, the index funds, like one that is based on the S&P 500, is considered a low-cost index fund because they're much cheaper to invest in compared to many other types of funds. And within the fund, they involve far less buying and selling, which can save you a lot of money. And they're also cheaper because we don't need to pay a fund manager to decide what to include. It's already decided for them based on the components of the S&P 500. And as a result, this is also the reason there is less trading or buying and selling within the fund. It's simply a buy and hold, and occasionally a company might change if it falls off the S&P 500 to be replaced by another. Warren Buffett saw this as glaringly obvious that fees can kill an investor's overall return, so he had a little fun with it. Back in 2007, he bet another company, Protégé Partners, that an index fund could perform better than a group of actively managed hedge funds over 10 years. Buffett picked the Vanguard Index Fund to represent the S&P 500, and it won big. After 10 years, the group of hedge funds Protégé Partners picked only made a profit of 36.3% after all the costs, while the S&P 500 made a profit of 125.8%, so much bigger. Buffett now talks about how expensive it is to hire people to manage your money and how in the end these managers often don't do better than simple index funds. So why are index funds better? Well, it turns out that for the most part, the people who actively manage funds don't always do a stellar job. Standard & Poor, a massive company that publishes financial research and analysis on stocks and bonds and commodities, well, they've been evaluating this comparison for over 20 years and found out that after 5 years, 84% of these actively managed funds don't do as well as they should against the benchmark. And after 10 years, 90% of them fall short. And their research is even after accounting for the fees and getting rid of the worst performing funds. This poor performance is a result of, in part, because these managers come with a high cost. They charge a lot of money for their help, and it takes away from the investors' profits. Standard & Poor also found that they tend to buy and sell investments too much, which can lead to mistakes and incur high taxes. Also, these professional traders are competing with each other, and since they all have access to the same information, it's hard for them to have a really big advantage over one another. In contrast, if you simply pick an index fund that takes little to no work to manage, you would spend less money, which results in higher profits. So whether you have a lot or a little money to invest, Warren Buffett suggests using low-cost index funds like the S&P 500 because they tend to give you a better return in the end. And if Warren Buffett, with a whopping $216 billion net worth, thinks that low-cost index funds are a great idea, it's probably worth considering for our investments as well. If you recall, I thought I could outsmart and outpace the market, and I had to learn the hard way to let go and embrace the simplicity and enjoy less risk in the world of index funds. Not to mention, by investing in this trail mix bag of companies, we get the benefit from all the hard work of people making these major corporations successful. You work hard for your money, so let's start to learn how to let somebody else do the heavy lifting. So if it's okay with you, we're going to do 2 little things. Well, maybe 3 actually. This was part 1 of investing for beginners, and we're going to split this up into a mini series since there's actually a lot to learn about investing. I could do it like so many others and tell you all you need to know in 10 minutes or less. But in reality, I want to help you build a foundation so you can make informed decisions about your investments. There is no point earning oodles of money only to lose it over something silly that could be avoided or to miss out on life-changing returns because you wanted to outsmart Warren Buffett. Okay, so first thing we're going to do is a quick recap. We learned that the purpose of investing is so that your money can make money for you and that it needs to at least keep up with inflation, preferably outpace, but at least keep up with inflation. We also learned that you can generate profit based on the sale price of a stock or fund, but also as a result of dividends. And we also learned that funds are like an organized bag of trail mix and that the purpose of an index is to track a stock market or a marketplace of stocks. And of course, we just walked through Warren Buffett's advice about index funds and why he would advise us this way. Great job. That was a lot to take in, so I'm giving you a thumbs up. In the next part of Investing for Beginners, we'll chat about some of the things I look for when choosing a fund, and I'll show you some of the components of a fund that you could be looking for as well. I'll take you over to a popular brokerage website so we can start to dissect some of the information from there, and then you can feel empowered when you start to do research on your own. We will keep it simple, but I will show you how to do some of these things so you can use it as a launch point for you. And remember, you must invest in some form or another. Otherwise, year after year, your money is becoming